you thought about the importance of financial planning in the wealth decisions you make? This week, we're speaking with one of Canada's foremost experts with regard to financial planning and teaching some of the best planners in the country how to plan and what to think about when they do their planning so that consumers can make better wealth decisions. You won't want to miss this. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. My guest this week is Jason Watt. Jason has been educating advisors towards licensing and certification for over 17 years. He's a proponent of evidence-based financial planning and an active volunteer both within the financial planning community and in the broader community. He's currently working as a consultant for the financial planning industry. Jason, how are you today?
I'm doing real well, John. How about yourself?
Also very, very well. You are one of the foremost authorities in financial planning in Canada, and so it's my pleasure to have you on today. And I thought because of your expertise, we could do something which is a little more funky, a little more fun, and just have a discussion about decision-making from a financial planning perspective. And a lot of the things, oftentimes I will have guests that are authors or regulators or product suppliers, and they'll talk about products or they'll talk about perspectives. But with you, we can talk expressly about financial planning. And I think that's a wonderful opportunity. So I'd like to begin by giving you the floor and having you maybe tell the viewers a little bit about yourself before we get into a bit of an interactive session.
Yeah, sounds good, John. Thanks. And I love talking about financial planning, so this works nicely. So I was, prior to any of this, I spent 14 years in the Canadian Armed Forces. I did some operational deployment there, which maybe give me some perspective that not everybody would have. I don't know. In 2006, I left and came into what was then the family business, primarily doing, you mentioned licensing in my intro, primarily doing life licensing and working with people who had life insurance licenses to keep their CE credits up and running. So maintain proficiency. In 2009, 10, kind of by accident, John, I landed in financial planning education. We had it in the business, pretty small side venture. And we had a contractor who went to a class in Ottawa and didn't do a great job. And the class called me and said, "We're going to leave if you don't replace this guy." So not knowing anything, I hopped on a plane, went out there, read the material on the plane on the way out, sort of hammered down what I needed to hammer down, taught the class. And then lo and behold, I became an instructor in our financial planning programs. I wrote my exam not long after, did well on the exam, and I have been sort of learning the financial planning space ever since.
It's interesting you say that because I know for a fact that a lot of people who aced the CFP exam, just this most recent go round, aced it. They tell me flat out they're very open about it, that they did it because they did as well as they did because of your tutelage and you're helping them to prepare for those exams. So you've obviously become not only a person who's an able planner, but also a very compelling teacher to help people understand and apply what they learn in financial planning.
I think, it's funny, John, so much of it is just show up. And a big part of what I think I bring to the table here is I've been very active in the financial planning community and just things like going to conferences that FP Canada puts on, Financial Planning Week, but others. They used to do a really good educators event, volunteering a lot of places, having conversations with people. And the exam is what it's supposed to be. It's a proficiency exam in that area of financial planning. So those folks I know who you're talking about here might give me some credit, but honestly, on this most recent exam, 3 of the 4 top CFP candidates were students in our programs. And I think they're all people who would have done well on the exam no matter what. I do appreciate the kudos. It's always nice to get that, but they are people who care about their financial planning outcomes. And John, I like it. I know you volunteered a lot with FP Canada over the years. And I think that we should all look at FP Canada, say they are actually producing an exam that does a good job testing proficiency.
Good. That's a great way to say it. So let's get into a bit of an interactive session where we talk about some of the great financial planning questions that everyone likes to ask. So the podcast is called Make Better Wealth Decisions. And I think one of the most basic questions that people have when they are setting money aside for a rainy day or for retirement or whatever is whether they should be putting that money into an RRSP or a TFSA. So let's begin there. On the one hand, it's a very basic question. On the other hand, it has a whole series of different rabbit holes you can go down. So maybe what do you prefer? Why, when, and what are the exceptions?
Right. And I mean, add the FHSA to the mix and you get this further complexity. I will say that in general, John, I prefer the RRSP. And I think there are good reasons for it. I think first off, the thing that we overlook with the RRSP is that we have such a complex tax system. And in that complex tax system, as you well know, your net income, your line 23,600 income, drives so many other outcomes. And an example here will be Canada Child Benefit. So what you get then is, all else being equal, sort of, I know this, the RRSP and the TFSA, if you're at the same tax rate now and same tax rate later and all that they really come out neutral. I think that's fair, John. The concept though of an effective tax rate, that is where, again, Canada Child Benefit, but other programs too, we can look at the way childcare expenses are deducted. You can look at the impact on your medical expense tax credit. There's a bunch of stuff that falls out of that net income calculation. And that net income calculation is made better by an RRSP contribution and not changed at all by a TFSA contribution. So it's not necessarily like TFSA versus RRSP. It's tax deduction versus non-tax deduction that tilts it for me. And I'm going to say that also is going to lead me to favor the FHSA in cases where that account makes sense. Now, that's not to say nobody should be using TFSA first. That would be a foolish, I think, idea to promote.
Okay. One of the things that I know that some people have talked about is tax bracket arbitrage. So they'll say, if you're in a high bracket when you're earning money, you should certainly put money into the RRSP now, because when you retire, you'll likely be in a lower bracket. So although it's either a deduction in and tax out with the RRSP or no deduction after tax dollars in and no tax on the way out with the TFSA, the difference would be that with an RRSP or an FHSA, there are deductions on the way in, but then later on down the road, you might be able to be in a lower bracket. And so there's an opportunity to play a game of all else being equal, probably for most people, unless maybe I would say if you're in the lowest bracket, maybe it might not make much of a difference one way or the other. But if you're anywhere beyond the second bracket, you're probably going to be an opportunity where you'll get a bigger deduction on the way in than a taxable on the way out.
Yeah. And I mean, you can model this in your financial planning software, John. You can run the math here, but I generally agree with you that you're probably, just think of somebody who makes $100,000 a year and puts $10,000 in their province, deduct at around 30%, give or take. And then when they retire, assuming that RRSP is accumulated to a substantial value, which it should have, they're going to be withdrawing. That's going to be the majority of their retirement income. And they're going to be withdrawing that at the lowest tax bracket and at probably the tax bracket they were in when they were working. So you're looking at some of it coming out at the same tax bracket you were in, but not all of it coming out at the same tax bracket you were in. That we want to call that tax bracket arbitrage. I think that's a good term here, John. Yeah.
And so I've got another one for you, and that's CPP deductions. And specifically, maybe not so much the deductions, because you've got to put that money in no matter what, but when to take CPP. And a lot of people have views on this. I know I have mine, but before I share mine, I want to hear yours. What are your thoughts on when to take CPP?
I'll be curious to hear if we differ on this, and I can't recall if we do. I'm going to give a lot of credit to Bonnie Jean McDonald. I know you know Bonnie Jean, and she's active with the National Institute on Aging and as a prof at Toronto Metropolitan University, if I'm not mistaken here. And she wrote what I think has actually become a surprisingly influential paper way back in 2018 or thereabouts. And it was sort of done, I think you actually might have had a hand in this from the FP Canada Foundation perspective. So FP Canada Foundation and the National Institute on Aging sponsored that work. And she did a really good job here of breaking down why people should wait as late as possible, as late as they can afford to, in almost all cases. So my preference, I would agree with her math here. And she did some really complicated actuarial math, but she also did some more straightforward, sort of speaking to human being math, where she showed that delaying is almost always the best possible decision. And since she wrote that paper, we've actually seen a shift. So I think maybe it's not that people who are taking CPP read that paper, but I think a lot of financial advisors and financial planners and other decision makers read that paper. And it has caused this push. And I know it's still the majority taking it pre-65, but it's not such a majority as it was when she wrote that paper. So I really prefer deferral, deferral, deferral. And I think that there's all kinds of reasons for this. I'm sure you have yours here, John.
So I'll take the opportunity to chime in, Jason. We agree. And that's because we both have read Bonnie's paper and are familiar with the things that it found. My recollection was that when the paper came out, only about 1% of all Canadians were waiting until the last possible moment, which is their 70th birthday. So most people know that you get an extra 0.6% for every month before your 65th birthday and 0.7% per month every month you wait after your 65th birthday, so that it works out to being a 36% reduction if you take it on your 60th birthday and a 42% bump up if you wait until your 70th. And one of the things that we talk about on this podcast and elsewhere is decision making. So the podcast is called Make Better Wealth Decisions. And this strikes me as being a very clear example of where the framing of the question will go a long way into informing what your decision is, because we start talking about 65 as being the normal age. And if you would take it before, you're taking it early. And if you're taking it after, you're taking it late. But given that the mathematics are such that 95 to 99% of people are better off waiting until the last possible moment, we should probably talk about taking CPP at age 70 as being the normal decision. And anybody who takes it before their 70th birthday is taking it early. And the other 95% who wait until age 70 are taking it at the proper time. Now, that might be a bit controversial, but that would be the way that I think would be a good way to get people to get their head around what it is we're talking about.
Yeah, I think that's a reasonable framing. And the only challenge I would pose to that is the government really presents it as age 65 being the normal age. So you might communicate that with your clients and that might work. And it probably does work, John. I think if you start talking to somebody when they're 52, 53, something like that, if you are talking to somebody when they're 59 or 60, I bet you that's a lot more difficult framing.
Yeah, that's fair enough. But it's funny how a lot of things, our perception of things will depend on just the way they're presented initially. And that actually brings me back to the tax-free savings account. When Minister Flaherty brought out the idea of a tax-free savings account, I don't know if that was 13, 14, 15 years ago, people thought that it was to be an account to be used for savings because it's a tax-free savings account. Had it been called a tax-free investing account, I think the products that people would have put into that box might have been different, only because of what they called it. But I think there's a signal, oh, it's a savings account. That means I put my savings money in there. And it's funny because once that idea takes hold, it's difficult to disabuse people of those preconceived notions, which are unintended, but nonetheless consequential.
Yeah, and I've certainly heard a lot of people with that same theory, that TFIA or some version of that, right? Yeah, framing is so important. I'm with you. Yeah.
Let's talk a little bit about financial planning. And the way I introduced you is absolutely the way I know you, as a person who is evidence-based with regard to financial planning. Can you give me an example or two of a financial planning decision where you run the numbers and use the software to come to a conclusion, and is specifically where the conclusion that you might come to might not be what you intuitively expected you would find?
Yeah, this is a tricky question. And this is a problem. And I know this is part of what you've done some volunteer work in the past to address. It's such a tricky problem in financial planning today. I think it's very good to have this aspiration to be evidence-based. And there are some places where the evidence really does show us a specific outcome, but we're still early days for good published research in the area of financial planning. And I think even some of the, I think you're well aware of the replicability crisis in social sciences. So sometimes we look at papers, even papers by well-known and well-respected researchers. I think you might have some of those papers, some of the books on your shelf behind you.
Background, yeah.
Yeah. And we get kind of this mixed bag of, how strong is the evidence? What does the evidence actually show me? And I think a good chunk of the decisions where we say, I'd like to be evidence-based here, we are still early days where the evidence is not so strong. Now, that said, there are some places where we can run calculations. And a good example of this, one that I always show in class is the benefit of something like electing out of a spousal rollover. So as you well know, John, on the death of the first spouse, we can roll assets, registered and non-registered assets, over to the surviving spouse, really deferring tax. Now, I've already argued in favor of deferring tax, but there are cases where it does not make sense. And that's where you can calculate what's the tax burden on that first death if we were to opt out of deferring tax, and what's the tax burden on the last death if we were to take advantage of the tax deferral. And I really like this exercise with my financial planning students because it gives you sort of a concrete input and a concrete output. And I don't know how often the result of that calculation is surprising, but I think it's something that we should do. I think it's a good example where you can really master that skill of comparing the benefit of tax deferral versus the consequence, let's say, of not taking that tax deferral. So I don't know if that's a helpful example, John, but that's the one that I spent a lot of time on in class.
Well, I think this actually dovetails very well with the question about when to take CPP, because a lot of this, as I say, in any kind of modeling, it's garbage in, garbage out. And so then the question, I think, hinges largely, or at least somewhat, on how long you think the surviving spouse is likely to live.
Yeah.
And one of the things that we frequently get wrong in Canada is that we underestimate longevity risk, which is to say a lot of us live a lot longer, especially those people that are fairly well-to-do and in good health and are able to engage the services of a financial advisor or a portfolio manager, but they have someone helping them with their financial decisions. Those people tend to skew toward being more longer lived. And as a result of that, the assumptions that they say, well, I'm going to be dead when my dad thought he would die by the time he was 71 and he made it to 82. And the decisions he made, for instance, as to when to take CPP might have been different. What's the old saying, if I'd have known I was going to last this long, I'd have taken better care of myself. Well, a lot of Canadians are doing a really good job of taking care of themselves, and they don't think about what that means in terms of how long their portfolio has to last. And then the tax implications of taking out withdrawals for 30 years as opposed to 21 or 22 years, because that's how long they are budgeting for the amount of life they have left in retirement. So those are the sorts of questions. No one knows when their time is up, but those are the sorts of questions that it would be good to actually run some numbers and show people and then let them make an informed decision. It's based on assumptions. We don't know what the outcome is going to be, but at least it's a more informed decision. And I think that has some value. So you were mentioning some of the books I have behind me. So let's talk about that. Let's talk about a lot of the books that I have behind me, because the podcast is about behavioral economics and decision-making.
Yeah.
I'd like to get your take on behavioral economics as well. And that's especially interesting because it's a social science and it's difficult to put in interventions that will help people with their decision-making and a financial planning perspective, knowing that we're all human and that humans make decisions that are based on heuristics and rules of thumb and biases that we all have. What are your thoughts about the way behavioral economics is being incorporated into financial planning in 2025?
Yeah, I think this is a really interesting question. And I'm going to lean pretty heavily on maybe 2 years ago, Dan Crosby, for whom I have a ton of respect. I think that's one of the books on the shelf somewhere back there. I think you probably got at least
in
one
fact,
Crosby
Daniel
book.
you did a testimonial for Bullshit. So Daniel
There you
was
go.
kind enough to even help me out. Yeah.
Fantastic guy. And he had Brian Portnoy on his podcast when he was still doing guest episodes. And they talked about this kind of state of the union of the gentleman, just amazing. He makes the point that if we're kind of thinking about this where we were 10 years ago, just kind of a list of heuristics. I mean, it's helpful. It's not useless information, but it's not really where we want to be at. And I think when we just focus on, if you look on like the Wikipedia, I don't know if you've ever done this, John, if you look on the Wikipedia list of behavioral heuristics, there's like 300 things on it. It's just insurmountable, right? The argument that I think they came to, the conclusion that they came to on that really great podcast episode, was that what we ought to be doing here is just help people to make decisions that are aligned with sort of how that person views the world, or that are aligned with that person's, I don't want to say just values here. It's more than that, John, right? It's, how do when you say evidence-based, it might mean something a little bit different. It shouldn't probably, but it might mean something a little bit different than when I hear evidence-based. And, that recognizing that you and I are not the same person, that should be part of what motivates how we deliver financial planning advice. And I think we're still relatively early days for that. I think that we haven't gotten past kind of that, behavioral economics thing that we were at, where it's just a list of heuristics, which again, not irrelevant, but far from telling the whole story.
I have to admit that I'm struggling with that too, both in terms of the things that I write, but also in the work that I do when I give advice to retail clients. How do you find a way to get the rubber to hit the road in a way that is positive, accretive, client specific, and still not being, I don't want to be manipulative. You just want to be able to help people see things as they are. And it's very difficult for certain people when you know certain things, it's just natural to have opinions. And so this is how things are. And then of course there's people like me saying, and this is how they ought to be. This is how they should be. And you have to be careful not to go too far with this is how they should be, because first off, I'm human, I make mistakes. And then secondly, even if my perspective is correct for me, what if the person I'm talking to has a different perspective? And so now, some people will say, you can't take it with you and they want to spend it. And others will say, absolutely not. If I don't leave $250,000 to each of my 2 children, I will have failed as an individual and my time on this earth will have been, or whatever. But you get these stories where different people, it's not like there's a right or wrong answer. It's a personal answer. And then you've got to find a way to make sure that people's values are being respected and reflected in whatever plan you implement. And that is not the sort of thing that you can just lend itself to a textbook, because it's very customized and it's very unique to whoever it is you're speaking with. Before we set this up, we were going over what we might talk about. And there was one thing that you were suggesting that I should talk to you about and ask you about, because it's one of your favorite topics. And believe me, it is near and dear to me. And that is a paper that came out a little over 30 years ago called The Arithmetic of Active Management, written by William F. Sharp, I think in the Financial Analyst Journal. And it was a paper that I still use maybe more than any other paper that I cite all the time. And I can tell you why I like it, but you told me that you liked it. And so I would like you to tell me what it is about that paper you enjoy, and then we can maybe spend a moment commiserating.
Yeah, this can be good or bad. It's short. It's simple. He gets to the point. He makes the point in a mathematical perspective. He shows the math, sort of brings the numbers, and it's a relatively consumable, considering published in the Financial Analyst Journal, where stuff tends to get pretty nerdy. And he really he drove home an elegant point about the cost of maintaining. He talks about active versus passive. I don't love that. I think we've kind of got past that today, but the point is that when you're paying 2%, which was fairly typical at the time and still unfortunately common in Canada, when you're paying that is probably not actually yielding you any meaningful benefit. And it's something where, coming from where I came from, John, I started in this business primarily dealing with insurance folks, so, at seg funds and all that, and then kind of just moved into financial planning. And my early financial planning clients were largely the shops where we still see a lot of active used. And in fact, I have a lot of conversations with people who are, dancing around how they would either within those shops start to use less expensive products, or how they might move and take their business. And I don't want to, badmouth those shops wholesale. There's lots of good stuff that happens there. But as I see more and more on the investing side, and investing is only one slice of the pie in our financial planning conversation, I get all of that. But really, it's becoming, I think, more and more compelling that we have a good suite of low-cost investing products available, and given pressures on returns and all that goes along with that uncertainty around returns, it just makes less and less sense to me every day that you would be stuck in a product with unnecessarily high fees. I think that's a safe way to say that, John.
So let me see if I'll summarize the paper very quickly for people who are not familiar with it. So it's 2 and a bit pages long. You can read it in 8 or 9 minutes. And it basically says that the average return of any given benchmark, an index, is the return of an index product, is the return of the benchmark, the S&P 500 or the TSX, minus the cost of the product, which is, let's say, 15 basis points. So if the TSX does 8% and you've got a an ETF that tracks it, it's going to cost 15 basis points. You're going to get 7.85 as your return, the return of the benchmark minus the cost of the product. But the benchmark is nothing more than the sum of all active and all active products and strategies. And if the return of the benchmark index product is the benchmark minus the cost, that means that the return of the active products is the return of the benchmark minus the costs. The cost of active products are oftentimes anywhere from 5 to 10 times higher. And so that difference in price, typically more than 1%, and oftentimes more like 125 or 130 basis points, certainly 1%, that goes straight to your bottom line. You can save, let's call it 1% in return just by an expected return on average on a balance of probabilities. There are exceptions in both directions, but all else being equal, if your product costs 1% less, then in the long run, odds are it will return 1% more. And that is something that a lot of investors don't recognize. And B, and here's my question for you, in your view, do the people giving the advice recognize it and do it anyway, or do they not even recognize what the evidence says?
Okay, so my belief here, I mean, I talk about this in class, right? When we're going through this section, the investing section of the financial planning curriculum, we absolutely talk about index investing as kind of the baseline low cost way to do things. And then we talk about active. And the question is always, are you generating enough value for the fees that an active investor is paying? And there's a question of, are there alternate ways to generate that same value or alternate ways to charge that same fee? And I do think, John, that, I don't know, it's a tough question. I think to some extent, and you know this, you come into the industry and you're taught a way of doing things. And that way of doing things, it really gets into your DNA. And I was like this, right, John? I would say that it took me, a few conversations like this, a few exposures to this concept before I made that shift away. You certainly hear compelling stories from the active managers, right? And now, how often do those compelling stories stand up to evidence? Well, that's a tricky one. And again, I certainly don't think it's malice. I don't think that you have cases. If it was malice, there are other ways that I could exercise that malice that would be more productive for me, right? That's a different question. I think I am going to chalk it mostly up to, this is what you learned early, and what you learned early has gotten you this far. So you're going to have a pretty heavy lift to come away from that.
Ironically, that's exactly where I came down on it. So my previous book, Stand Up to the Financial Services Industry, talked about that. And my conclusion was that it's a bit of a two-step, that there's a bit of, I'll go so far as to say, willful disinformation from product suppliers and even employers about the value of active management. But then a lot of advisors, because that is how they're socialized and because of peer pressure and conformity in social psychology, that's just the way it's in their DNA. That's the terminology you use. And I think that's actually a good way of putting it. It's just that, well, that's just the way things are done. And they unwittingly parrot what they've been told or what they've been socialized to believe to their clients. And as a result, a lot of advisors are, in my opinion, engaging in misinformation, but that is because they have digested disinformation from other people in the industry. But unless and until the cycle is broken, it will persist. And unfortunately, there's still a lot more money that's being put into active products these days than I would have thought would have been necessary. But here we are. All right, so let's see if we can wrap this up. Podcast is called Make Better Wealth Decisions. You've been around the block a number of times. If it was up to you, Jason, what advice would you give to people to help them make better wealth decisions?
All right. I think financial planning is about three things. I know there's a list of, or a danger of using lists here, John, but here I go. So there are three things that if you're engaging with a financial planner, or if you're a financial planner delivering financial planning advice, I think there are three outcomes here. Number one is that our financial planning outcomes should help us avoid big mistakes. And these big mistakes, that we just talked about, like active versus passive, fine, whatever. But I mean big mistakes that can really blow you up. Housing decisions, bad decisions or bad outcomes maybe with respect to inheritances, marriage. There's a bunch of these areas where you can really sort of wipe out hundreds of thousands of dollars of wealth all in one kind of decision. Sometimes cars can fall into that category, depending how we treat those. So I'm going to say avoid big mistakes, number one. Number two is going to be that we want to have optionality. As you rightly said earlier, John, we don't know. We use a ton of assumptions in our financial planning outcomes, longevity, rates of returns, employment income, how long we stay employed, at what age we retire, health, just so many assumptions, too many that you can't appreciate them all in order to do that. And then the third and the trickiest one, and what overlaps with our conversation earlier about sort of the state of human psychology and financial planning, is we should have an alignment of our money with our values.
All right. Well, that's been wonderful. I want to thank you for your time today. For those people watching on YouTube, you may have noticed 4 or 5 people walk by behind Jason with Oilers jerseys on. So Jason's based in Edmonton, if you didn't already figure that out. And the whole country is behind the Oilers. So I want to wish you all the best of success. And I want to wish Canada's Oilers all the best as we head into the remainder of the Stanley Cup final.
Maybe one day we'll see you at least make it this far, John.
Thanks.
All right. Thanks so much.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.